Welcome to the deep dive. Ever stop to consider that building real freedom, the kind that can genuinely liberate you from the 9 to 5? Well, it might just come down to something as maybe unassuming as consistent, thoughtful personal investing.
It sounds almost too simple, doesn't it? But in Guy Thomas's book, Capital, we meet these 12 individuals where this quiet approach, it really unlocked a powerful level of independence for them.
Yeah, and what's so interesting, I think, is that these aren't your typical Wall Street titans, right?
Right, exactly. We're not talking about inherited wealth or, CEOs cashing in massive stock options. Most of these people started with relatively modest savings.
Right.
And they built significant financial flexibility. The book calls it free capital, just through their own smart decisions in the stock market.
And that's perfect for you, the learner, if you're intrigued by these, less conventional paths to financial independence. That's exactly what we're going to dig into today.
Precisely. Think of this as your shortcut to understanding their journeys. We've gone through all 12 stories, pinpointing those crucial insights, the unique skills, the temperaments, the things that really set them apart.
Our aim is to give you a clear grasp of their approaches without getting bogged down in every single detail.
And it's worth mentioning, for real openness, many names and some personal details in the book were changed.
Okay.
But the investment details, those are accurate. Though two individuals, Peter Gyllenhammer and John Lee, they actually used their real names.
Good to know. Okay, let's dive in. Who's first?
Let's start with Luke. The author calls him an investment geographer.
A geographer. Okay. What does that mean in investing terms?
Well, it means he thinks top-down. He starts with the big picture, macroeconomic themes, broad trends. Think interest rates, commodity prices.
Okay, so macro first.
Right. And then he identifies individual companies that fit within those larger trends.
And his core idea, I found this really resonant, is that the scarcest resource for investors isn't capital, it's attention.
Yes. Which leads to what he calls judicious neglect.
Judicious neglect, I like that. Making smart choices about what you can afford to, ignore.
Exactly. Now, his background is interesting, too. He wasn't always a full-time investor.
No.
He started as a transport planner, then got an MSc and moved into investment banking. Pretty demanding world.
I bet.
But after about 15 intense years, around 1999, he was ready for a change, did a bit of consultancy. But the real turning point came in March 2000.
What happened then?
Well, the trigger is quite something. He was advising Marconi on restructuring its debt.
Okay.
And he realized his personal share portfolio gains, just for that month, were way more than his salary, even more than his firm's fees on the deal.
Wow. That's an aha moment, all right.
Definitely. So that led him to leave traditional employment in early 2002. He was 47. Became a full-time private investor.
And his investment style reflects that long-term view, right? Very concentrated.
Very long-term. For a big chunk of the 2000s, his portfolio was heavily weighted towards the oil sector.
Which fits the top-down macro thinking.
Exactly. He's also really wary of leverage using borrowed money and avoids short selling.
Betting on a price fall.
Yeah. He actually had this dramatic experience in his banking days executing a short squeeze in the bond market, and that completely turned him off shorting stocks forever.
I can imagine. So no leverage, no shorting. What else? There was something about bulletin boards.
Ah, yes, that's another notable thing. He uses online bulletin boards extensively, like tens of thousands of posts on places like Motley Fool.
Which seems odd, doesn't it? For someone who trades so infrequently, only a few times a year.
It does seem counterintuitive, but for Luke, they serve a purpose.
Which is?
He sees them as his filing system, a record of his thinking over time, and he also uses them to gauge market sentiment, sort of take the temperature.
Even though he doesn't trade based on that short-term feeling.
Right. It's more about understanding the environment. So the key takeaway for you, the listener, it's really about focusing your attention wisely.
That judicious neglect, again.
Exactly. You don't need to analyze everything. Sometimes choosing what to ignore is the smart move.
Okay, interesting. Who's next?
Next up is Nigel. He's another investment geographer, like Luke.
Okay, so top down again.
Yes, but with a specific focus on cyclicality. Markets like shipping, mining, property, things that go through big booms and busts.
And his background fits that too, right? Psychology and shipping finance.
That's right. A psychology degree from Harvard, then almost 3 decades in shipping finance. So he really combines understanding market cycles with investor psychology.
Which he really emphasizes, doesn't he, the
Yeah.
psychology part?
Oh, absolutely. He says, what other people are thinking is at least as important as what you are thinking yourself.
Mm-hmm.
You want to anticipate how other people's thinking is going to change before they know it themselves. That psychology background definitely comes through.
It seems like it gives him an edge. Did he have a specific turning point, too?
He did. End of 1999, he had this 10-bagger windfall.
10 times his money. Nice.
Yeah, from a small, illiquid mining holding called Toucan Gold. It suddenly turned into an internet company, kind of unexpectedly.
Huh. Right place, right time.
Pretty much. And that gave him the funds for a long break and eventually full-time investing.
And where does he tend to invest?
Quite internationally. He focuses a lot on Canadian miners, for instance, and he's willing to participate in fundraisings, travels to mining conferences globally.
So a broader scope than just the local market.
Definitely. And connecting this to the bigger picture, Nigel really gets how things like U.S. dollar strength and leverage affect global asset prices.
Ah, the geographer perspective again.
Right. He sees these forces creating bigger swings, more pronounced booms and busts. So his strategy is about betting on swings, being flexible.
And like Luke, he uses bulletin boards too.
Very actively, yes. Maybe even more so because he spends a lot of time in Hong Kong while trading Western markets.
So it helps bridge the distance, combat the isolation.
Exactly. Combats the isolation of being a solo investor, and crucially for him, as a geographer focused on sentiment, it gives him a feel for what others are thinking.
That makes sense. It's a key difference, isn't it, between these geographers and the surveyors, the bottom-up guys.
Absolutely. Surveyors dig into company accounts, the hard numbers. Geographers like Luke and Nigel, they're paying much more attention to shifts in market sentiment.
Stuff you can't just get from a balance sheet.
Precisely. And that's where insights from online communities can be really valuable for them.
So the key takeaway from Nigel for our listeners:
really pay attention to those bigger market cycles and, crucially, the often irrational psychology that drives investor behavior.
Got it. Okay, let's shift gears. Who's Bill?
Bill is quite different. He's a former electronics engineer, and he is all about the raw numbers. Classic value investing.
Value investing. Looking for bargains based on fundamentals.
Exactly. And he's done very well since leaving full-time work. Increased his free capital tenfold in just 8 years.
Wow. Impressive. So substance over style for him.
Totally. He's not interested in marketing hype. He wants the underlying data. Interestingly, though, despite his electronics background, he was initially quite cautious about tech stocks, very aware of potential project delays, commercial failures, that sort of thing.
Understandable.
Yeah.
What enabled his shift to full-time investing?
Well, like for many, the increasing ease of accessing information online was huge, made being independent feasible.
Right.
But another key factor for him was spread betting.
Ah, betting on price movements without owning the stock. For tax reasons in the UK.
Exactly. Potentially tax-free gains. He opened his first account in 2002, and just months later, he was doing so well, he ditched any thoughts of going back to engineering.
And spread betting also lets you short sell, right? Did he use that?
He did, very effectively with KPN Quest, that defunct telecom company. He used his industry knowledge, plus a compelling broker note.
Smart. What about managing risk? Does he use stop losses?
Interestingly, no. He's reluctant to use predefined stop-loss orders.
Why is that?
His thinking is, if a share price drops after he buys, and the fundamental reasons haven't changed, he'll typically buy more.
Averaging down.
Right. He feels stop losses can force you to sell at exactly the wrong moment, almost like admitting the market knows better than you.
Interesting perspective. So what are his core metrics? You said value investing.
Primarily the price to earnings, or PE ratio. That's his main initial screen.
Okay.
But he's adapted. He'll use other things like price to sales or EV to sales for companies in recovery, or net asset value, NAV, for minor.
So flexible within the value framework.
Yeah, and he often combines these metrics with his own assessment and insights from just a few trusted posters on bulletin boards.
Learning from others again.
Definitely. He also talks about earnings visibility, how predictable a company's future earnings are. Finds that surprising forecasts don't usually come with an error range.
That's a good point. How quickly does he act on ideas?
Quite quickly, actually. If an argument seems compelling, even with limited initial research sometimes.
Really?
He puts it down to a fear of missing out. And, he admits, maybe a bit of simple laziness.
Oh, honest at least. What about organizing all this info, his filing system?
It's basically one giant Excel spreadsheet. Notes on companies, trade records, everything.
Wow. All in one place.
And he even developed this visual tool he calls the value spider.
Value spider.
Yeah, to graphically compare a share's financial metrics against market averages. Pretty neat.
Sounds useful. And his bulletin board use.
He monitors discussions, searching for specific posters he trusts. He learns from their ideas. Doesn't post as much as Luke or Nigel, but when he does, it's very data-focused.
So the takeaway from Bill.
It's the power of focusing on that fundamental data, yeah. Not getting lost in overly complex stuff, but also being open to learning from the reasoned insights of others.
Makes sense. Okay, now John Lee. His story sounds quite different again. Public service and investing.
Yeah, it's a fascinating combination. He shows that serious personal investing can coexist with a really demanding public career.
He was a conservative MP and minister, then a Lib Dem peer.
That's right. And his perspective is insightful. He felt having that second income from investments gave him crucial independence as an MP, especially since his constituency majority was quite slim.
So it wasn't just about the money, but the freedom it provided.
Exactly. And he was careful to avoid conflicts of interest, not investing in areas related to his ministerial roles.
And he's big on direct engagement, right? Visiting companies.
Very big. Attends numerous AGMs, annual general meetings, makes a point of visiting businesses on the ground, seeing the factories, the offices.
Does he think it improves his results? Or just something he enjoys?
He believes it helps his results, but he's also quite upfront that he genuinely enjoys the process, likes understanding the businesses.
And his portfolio, is it concentrated like Luke's?
No, much more diversified. Long-term holder, typically around 50 different stocks, a mix of main market and AIM, the smaller company market.
And he's a big believer in tax-efficient accounts, PPs and ISAs.
Absolutely. Consistently contributed the maximum allowed since they started way back in '87 and '99.
And that grew significantly.
Hugely. Tax-free growth. Back in 2003, his contributions of just over £126,000 had already grown to over £1 million inside those wrappers.
It's incredible, the power of compounding and tax efficiency. Did he use leverage?
Never. Not once in his 50-year investing career. Even when interest was tax-deductible back in the 70s, no spread betting either. Very risk-averse in that sense.
Even with a busy public life, he stays hands-on.
Very. Speaks to one of his two brokers every morning for an update. Prefers that personal touch over just checking online.
Interesting.
And he's been a trustee for large institutional portfolios, but that experience just reinforced his view that the real opportunities and maybe the fun lie with smaller companies.
More of a human element, as he puts it.
Yeah, where you can get to know management.
So after 5 decades, what's his core advice?
It boils down to common sense and patience. For him, investing, especially in smaller firms, is a fulfilling hobby as much as a financial activity.
So the takeaway here is about that long-term consistency, even with a busy career, and really understanding the businesses.
Exactly. The value of patience, consistency, and that direct engagement.
Okay, well, let's move to Sushil. His story sounds particularly poignant, investing as a path to independence due to health issues.
Yes, it really highlights that aspect. His career in business economics consulting was cut short by increasing disability, so he turned to full-time investing.
Did his economics background help initially? He studied econometrics, right?
He did, a strong academic foundation, but his early investment record was a bit erratic.
Why was that?
Partly down to poor information access back then, before the internet was widespread. He literally talks about getting stock prices from discarded newspapers he found in bins at train stations.
Wow, times have changed.
Yeah.
How did he handle the dot-com boom?
Successfully, actually. He recognized it was a bubble, but he consciously decided to write it for a while.
Risky.
It was, but he also gradually shifted away from tech based on fundamentals as it went on.
And his trading style is a bit unusual. Contrarian?
Yeah, quite contrarian. He actually wants the price to move against him after he buys or sells. He feels it gives him more chances to trade at prices he likes.
Interesting logic. Is he skeptical of theory?
Quite skeptical of standard investment theories. He prefers focusing on what he calls knowable changes in state. Basically, specific events or shifts he thinks he can understand better than the wider market. This leads him towards smaller companies where he believes he can get an informational edge.
And he's very independent, does his own accounts.
Very. Relies very little on advisors. Prepares his own accounts, tax returns, the lot.
Does he think his mathematical background helps?
He understands its limitations in investing. He emphasizes that qualitative information management, quality, competitive landscape, that stuff is crucial. You can't just rely on models.
And tax is a big factor for him.
It is, yeah. Not complex avoidance schemes, but he thinks carefully about tax efficiency. Believes the UK is actually quite favorable for investors using ISAs and spread betting.
What about leverage? Does he use it?
Cautiously. He bases his approach on the Kelly criterion.
Ah, the optimal betting size formula.
Right, which often suggests using less leverage than you might think is optimal.
So what's a typical day like for him?
Detailed research on his current holdings, searching for new ideas using screens and bulletin boards, talking to his broker.
And he does character research.
Yes, places a big emphasis on assessing management, even looking for potential signs of, well, crooks, as the book puts it.
So the takeaway from Sushil: independence through investing, independent thinking, and focusing on what you can actually know.
Precisely. It's about carving out that independence and relying on your own judgment and research.
Let's talk about Taylor next. Another investor managing health challenges, ME in his case.
That's right. And for him, investing became his main window on the world, a real source of engagement and achievement despite his illness.
And his strategy sounds intense, unleveraged plunging.
Yeah, it's a very concentrated approach, investing in just a handful of shares, often with a huge chunk of his portfolio in only one or two.
Inspired by people like Bernard Baruch.
Exactly. Baruch, Gerald Loeb, those legends of concentrated investing. Taylor believes it can be effective for smaller funds aiming for high returns.
But unleveraged is key there.
Absolutely key. A strong aversion to debt. No borrowing.
And he has an ability to be patient, to sit tight.
Remarkable patience, yes. He partly links this to his illness experience and also an interest in Buddhist philosophy, just waiting.
But that patience isn't rigidity, is it? He can change his mind.
That's the fascinating part. He combines that ability to sit tight for long periods with the flexibility to change his mind quickly if new information contradicts his thesis. Shows a real lack of ego.
That's a rare combination. Did his strategy ever change?
He shifted towards macro trading, betting on broad economic trends as a defense during the 2008 bear market.
Makes sense. And he's interested in older investment books, psychology.
Very much so. Likes the classics and books on trading psychology.
And he has this concept, the 20-hole punch card.
Yes. It's this idea that you might only get, say, 20 truly great investment opportunities in your lifetime.
So you have to be incredibly selective. Wait for the absolute best pitches.
Exactly. It fits perfectly with his highly concentrated, patient approach. Only swing at the fat pitches.
So the takeaway from Taylor is the potential power of concentration if you have deep conviction, patience, and the humility to change course.
I think that sums it up well. High conviction, discipline, and flexibility.
Okay, on to Vernon. He made money in tech, but his distinctive thing is buying the glitch.
That's his signature strategy, yes. Investing in companies after bad news hits, like profit warnings.
So explain profit warnings for listeners who might not know.
Sure. Analysts following a company have earnings forecasts. If the company realizes its actual results are going to be significantly worse, usually like 10% or more below expectations, they have to issue a profit warning.
And Vernon sees that as an opportunity.
Potentially, yes. He sees profit warnings or other glitches like a crisis in a whole sector or maybe a takeover bid failing as moments when good companies might get oversold.
Does he buy immediately?
Not necessarily. It's more about being ready to act when others are panic selling because of the bad news.
And he understands kitchen sinking.
Yes, that phenomenon where companies throw all the bad news out at once, sometimes even stuff from previous periods, to clear the decks.
Creating an artificially low base for future comparisons.
Exactly. Which can create an opportunity to buy before the perceived recovery begins.
Can you give an example?
QXL Ricardo, that internet auction business. He invested after a legal dispute caused a major glitch, made substantial returns, mostly in his ISA.
And he has a framework for decisions. Thesis, secondary factors.
Right. A structured approach. Core thesis, the main reason to buy, secondary factors that support it, and hygiene factors, potential deal breakers.
Applying that to find misperceived opportunities.
Yes, like with Haynes Publishing or Hansard International, where he felt the market was missing the real story after some kind of negative event.
Does he have a selling rule?
A simple heuristic. When they become popular, sell some. Take some profits when sentiment turns positive.
What about theory? Modern portfolio theory.
He knows it. has strong math skills, but doesn't find it very useful in practice for his style.
And he emphasizes time allocation.
Yeah, being careful not to spend too much time analyzing existing holdings versus finding new ideas.
So buying the glitch is about exploiting market overreactions.
Essentially, yes.
Yeah.
Capitalizing on excessive pessimism. The key takeaway is look for opportunities in those overreactions, but always do your homework beyond just the initial glitch.
Don't just buy bad news blindly.
Absolutely not. Diligence is still key.
Right. Now, Eric sounds like a real networker. His edge comes from social interaction.
Very much so. His primary advantage seems to stem from extensive interactions with company directors and other investors.
How does he do that?
He's incredibly active, attends AGMs almost weekly, organizes investor dinners, really puts himself out there.
Does he have a business background?
Oh, yeah. Strong business sense from a young age, made good money early on, built and sold a property lettings business before focusing more on shares.
And he prefers smaller companies.
Yes, finds them easier to research. And crucially, the directors are usually more accessible for direct chats.
And his research is thorough. Multiple interactions.
Very thorough. The book mentions his investment in Ben Bailey as an example. Lots of conversations with management before investing.
What kind of companies does he favor?
He's had success with sort of traditional dividend-paying family firms, but also selectively with high-growth tech companies.
And his selling strategy. Slice in the top.
Yeah, because he has significant family spending needs. As shares go up, he tends to sell portions gradually rather than all at once.
Does he use spread betting?
He does, mainly for tax efficiency and some short selling, but he notes his success rate on shorts is lower than on his long investments.
What's his day like? Lots of calls.
Seems like it. Reviewing news, talking to his network, and numerous phone calls with company directors. He stresses the importance of having difficult conversations to really understand things.
And he's good at AGMs.
Huh.
Asking the right questions.
Apparently very effective. Asks seemingly simple questions that can reveal a lot about the business and management's thinking.
So the lesson from Eric is the power of building relationships and direct engagement, getting insights others might miss.
Exactly. The value of that human network and direct communication for deeper understanding.
Okay, Owen next. Challenging background. Saw investment as a path to freedom.
That's the story. Started very young as a schoolboy stag.
Profiting from new share issues.
Yeah, subscribing to oversubscribed IPOs and flipping them quickly for a small profit. Just getting started.
Then he moved into prop trading.
Right, proprietary trading in the city, using the firm's capital.
What kind of strategies?
Opportunistic ones. Merger arbitrage, playing the spread between a target's price and the offer price. Capital structure arbitrage, exploiting pricing differences in a company's various securities.
Often using leverage.
Significant leverage, often. That's common in prop trading.
Did he have any big personal wins?
He mentions a moonshot investment in a turnaround situation, Horace Small, which he held mostly within his ISA.
How does he invest now? Still high leverage.
No, interestingly, his current approach uses much lower leverage, and he generally avoids shorting individual stocks now. Quite a shift from his prop days.
And he's an activist with closed-end funds.
Yes, he actively communicates his views to the non-executive directors, pressing for changes he thinks will benefit shareholders.
How does he do that? AGMs.
Prefers written communication, actually. Direct letters, persistence, not so much AGMs for that.
So the takeaway from Owen. Be open to opportunistic or special situations, but manage your risk. Adapt your strategy.
I think so. Be aware of opportunities, but also the risks, especially with leverage, and tailor your approach to your own goals and risk tolerance.
Makes sense. Now for Peter Gyllenhammer, the corporate engineer. Sounds serious.
He is the most substantial investor profiled, known for taking large stakes and actively restructuring companies to unlock value. The real activist type.
Swedish background, right. And some earlier setbacks.
Yes, Swedish. And he actually went bust twice earlier in his career, so he's seen the downside.
Why UK microcaps?
He finds their ownership structures more open compared to Sweden, where families often have tighter control, makes it easier to build a stake and influence change.
And he likes troubled companies.
Finds them intellectually interesting, yes. Enjoys the challenge of fixing them, creating value through that restructuring process.
How does he do that? Any specific techniques?
A key concept is managing working capital, the money tied up in day-to-day operations. He engineered turnarounds by releasing negative working capital, freeing up cash. YJ Level is cited as a prime example.
Clever. Does he have views on UK corporate governance?
Strong views, particularly critical of how company directors are often selected in the UK, contrasting it unfavorably with the Swedish system.
And the trading system?
He prefers an order-driven electronic system for small caps, like in Sweden, over the UK's market maker system, thinks it's more transparent.
What's his typical day? Research?
Lots of reading and research. Uses bulletin boards, quantitative screening pools to find ideas.
Does he see it as work?
No, he describes it as like playing 10 parallel games of poker or chess. It's the intellectual challenge he enjoys.
So the takeaway from Peter: understand the business deeply, and maybe even think about how value could be actively created, especially in smaller firms.
Exactly. It's about that deeper business understanding and the potential for strategic intervention.
Okay, almost there. Khalid, the day trader. The only one profiled who survived long-term.
Yes, and trades very high volumes, over 30 million hows a month. And his background isn't finance.
No, what was it?
The rag trade, the clothing industry. And he has little interest in fundamental analysis the numbers Bill focuses on.
So what does he rely on?
Heavily on analyst upgrades and downgrades. Price charts, technical indicators.
Like RSI, Relative Strength Index.
That's a key one for him, yes. Used to spot overbought or oversold conditions. He also looks at spread ratios between similar companies in a sector.
And he uses high-end data. Bloomberg.
Yes. Eventually moved to a Bloomberg terminal. Recognizes the edge you get from accessing market-moving info quickly.
Is there any academic backing for technical analysis or trading analyst recommendations?
Well, some research suggests there can be value, especially if you get the information early, before the rest of the market reacts.
And he uses RSI for spread ratios. How?
Monitors the relative price movements between, say, two mining companies using their RSI readings, looking for divergences or convergences.
So his day is just glued to screens,
Yeah.
news, data.
Pretty much. Focused on news flow, Bloomberg data, monitoring his positions constantly. Very different from the long-term investors.
And fundamental investors are often skeptical of it.
Very skeptical. But Khalid's long-term success shows that different approaches can work, even if they seem unorthodox to others.
So the takeaway: diverse approaches can succeed, even short-term technical trading, but it requires discipline and specialist knowledge.
Exactly. It's not for everyone and likely very demanding, but it's a path.
Finally, Vince, small-cap investor and runs an unconventional publishing firm.
That's him. A natural contrarian, you could say. Embraces unpopular ideas in both investing and publishing.
Going against the grain.
Definitely. He realized early on, partly due to health concerns, how important investing was for financial independence.
Did he have early success?
Yes, in both property and the stock market in the 80s. Notably, he sold his properties before the '87 stock market crash. Good timing or good judgment?
Does he use any specific techniques? Options?
He's used covered straddle sometimes, which is an options strategy, often for risk management.
And he moved abroad, Switzerland.
Yes, partly for tax reasons, having already maxed out the tax-efficient options like ISAs in the UK.
So the takeaway from Vince: the potential in contrarian thinking, but with a crucial caveat.
Right. Thinking differently can be powerful, but just being different isn't enough. You also have to be right.
That's a very important point. Okay, so we've covered all 12. Looking back, what are the common threads, despite all the differences?
It's fascinating, isn't it? Despite the diverse strategies and backgrounds, some key traits emerge. Well, almost all accumulated significant liquid wealth, often over £1 million, much of it in ISAs.
Which, as the book notes, is hard to do just by saving. You need good returns.
Exactly. And this wealth gave them substantial control over their time. That's a huge one. Freedom. They come from all sorts of careers. They all seem to have this future time perspective focused on long-term goals.
Not just living for today.
Right. Many had relatively few dependents, maybe giving them more capacity for risk or focus, and often a kind of ambivalence about traditional careers.
They weren't wedded to the 9-to-5.
No, and crucially, none were overnight successes. It took consistent effort over years.
Technology helped, but wasn't the magic bullet.
It facilitated things, sure, information access, trading, but understanding markets was more critical than understanding the tech itself.
And their view of money.
More about freedom and independence than just buying stuff. Often surprisingly modest lifestyles given their wealth.
What about leverage? Borrowing?
Generally a low appetite for it, often learned the hard way through experience.
And they enjoy it. the process.
Seems so. They genuinely enjoy the intellectual challenge, the process of investing.
Are they team players?
Mostly not in their investing approach. Very independent thinkers.
Foxes, not hedgehogs.
Yeah, the author uses that analogy, applying sophisticated thinking in different ways, not rigidly stuck on one big idea.
And skeptical of advice.
Often, yes. Relying on their own judgment and research rather than taking tips uncritically.
That's a really powerful summary. So the aha moment for listeners,
Yeah,
it's that these diverse paths show it is possible.
absolutely. For you, the learner, it demonstrates that achieving that kind of freedom through personal investing is attainable by understanding these principles, these mindsets, and applying them thoughtfully to your own situation.
Which leads to that final provocative thought.
Yeah, consider which of these investors' approaches resonates most with you. Your personality, your curiosity.
Could adopting just one or two of their, unusual and effective choices?
Could it lead to surprising, positive results in your own financial journey? It's worth thinking about.
Definitely something valuable to reflect on. We'd encourage you to mull over these strategies. Maybe even grab a copy of Capital for the full stories.
Yeah, it's a great read.
And perhaps think about which type of investor you might be, or aspire to be, even if it's just the quiet observer, the bulletin board lurker, learning along the way.
Thanks for taking this deep dive with us.
Thanks, everyone.